Okay, Tractor Supply, that's how it looks. So we can see definitely it's not in the city, it's somewhere in a suburb area, like we can see around the forest. And I looked at quite few pictures for Tractor Supply, and all of them they're located in areas like that. Yeah, absolutely, Dory. Rural people who are keen to talk to people, not machines. Interesting enough, I tried to go to their website from Russia, and I couldn't. Can you guys open their website? Like, I mean, Tractor Supply website. I just tell you the website. It's called www.tractorsupply.com, because I cannot open it. It tells me that you cannot open from your IP address. So they're blocking Russia. So they don't want Russian investors and Russian clients. Funny, but so in any way, they operate 1,769 stores right now in 49 states. So it's quite big company, but despite so big, it's nothing compared with the Home Depot. Home Depot much bigger. Okay, and look at their products. So it is opened. Yeah. Okay. So it means that I can't open it from here because guys from Israel they can open it. From Italy they could open as well, and from Australia you guys can open as well. So I presume it's only Russia which is blocked. Okay. So that's what they had: livestock and pet products, 46% of that. Hardware, tools, trucks, and towing, 22%. So, and a lot of trucks and towing, it's specifically for moving the stock from one place to another one. Then they have seasonal products such as snow blows, mowers, also gifts, toys, which is 90%, clothing and food for 8%, and agriculture 5%. So you can see their products specifically targeted to farmers, livestock, and pet products. Okay, that's why it's quite competitive. And probably if you compare with Bunnings, in Bunnings, like, okay, it's Australian brand, but it wouldn't be too much of that stuff, right? So they would be on different. And actually, clothing and food is the important part. So if you buy retail, like dresses, stuff like that, you go to Asana. But if you buy some kind of overcoats, right? So you need to go to this type of equipment. Okay, that's what they do. Okay, their online presence is not that good at all. Okay, I couldn't look at their website, but the fact that they cannot log in, it's already not good, right? So whatever policy they have, I presume it's not that great because they're not allowing to expose information about them to the broader market. Could be IP blocking. Who knows? I'm not sure what is happening, but that's the thing. Okay, industry. If you look, you can see industry, right? The biggest company in that area is Home Depot, and then Lowe's. So, and actually, they could be quite good company as well because look at value line. That's timeliness, and timeliness tells us the potential of growth within the next 12 months. So, what can we see that Home Depot, they have 2, which is pretty good, and Lowe's, they have 1. So that's why your home task will be to analyze these 2 companies. Okay, also. Now, if we look at Tractor Supply, it's only 3. So based on value analysis projections, right, they have less potential to grow within the next 12 months than Lowe's or Home Depot, like average growth compared with other companies in their universe. Now, when you look, you can read the industry analysis, but what they're saying that last quarter, like this quarter, which is ending up now, it was pretty good, and they expect good results, but we will see because Home Depot or Tractor Supply will have their earnings announcement next week, and you will be able to see how value line right on that aspect. Okay, in this particular case, we can see that on the size level, it's pretty small. You even can't see it here. I presume it's somewhere here it has to be. But compared with Home Depot, it's a very tiny company. Okay, hi Nona, hi Ian. Nice to see you guys. Okay, so let's have a look at value line. So that's what I saw. Timeliness 3, safety 3. Okay, so it's not the best, but still it's not as bad as lumber liquidator, okay, which has 5. So it's average in this particular case. Beta volatility is close to the market, so it's also good. Now we can see that price here 57 at the moment. Price is 52.28, like it was closed last night, like in your cases this morning. And P ratio was 16. Now if you calculate it, would be about 15. Okay, so quite low. If we look at the long-term trend, it's kind of growth trend. Here it was $6. If you look at previous years, it was even smaller. So the company is growing. And for us, it's important to look at those areas, which we're going to do in a second. Okay, we can see also that company has several splits on the way. Okay, and value line projection, we can see that it sees this company in within the next 3 to 5 years between $85 and $130. So which represents about from 50 to 125% growth. Now, because the price now is $52, so it's add another 10%. So it's from 60 to 135% growth from current prices. So which pretty good, tells us about 12 to 24% annual growth, which is quite good. So, okay, let's have a look. Sales level. So the first line. In 2001, it has $5.90 sales per share. Now it has $57. So it's nearly, what, 10 times growth on the sales level. Okay. If you look at earnings, they had 18 cents of earnings here and now 3.4. So they have nearly 20 times of earnings growth. So sales 10% and earnings 20%. So which is pretty good. It means that company shows us better earnings growth than their sales growth. Okay, so their expenses not growing as fast as their sales level, which is the best for us when we're choosing the company. Okay, let's have a look what was happening in a difficult time. Okay, from 2006, let's have a look from that area. So $14.7, $18, $20, $22, $25. So what happened? Absolutely. They keep growing absolutely non-stop. And actually, if you look from that point to this point, they never had even 1 year where sales growth dropped down. It's like never happened. So let's have a look at the earnings per share, okay? Because sales are sales. For us, more important earnings. 18 cents, 25, 36, 39, 52, 56, 60, 55, and then 79. So what we have here, we have only 5 cents drop. Who can calculate in percentage terms? How much is that? 5 cents on $60, on the 60 cents. Around 9%, right? Correct. Now, but if you look at the price drop, it was $14.4 and it went to $6, 6.7. So it's more than 2 times, about 60 or maybe even 70% of drop. The question is why? The sales were growing, profit, okay, dropped 8%, but the price of the share dropped more than half. Panic, absolutely right. So emotional, and that's what happened. And look at this. On the way, now we're going to look at technical, but we need to look what is happening right now. The price in 2016-15 was $96, $97, reached the peak in 2016, and now it's 52, 45% drop if you look at the highest point. But what's happening now? Last year they were sold $51. Now they are planning to close $57 of sales. Look at here. They were making $3.2. Now they're planning to make $3.4. The growth is still here in all aspects, but the price collapsing down. Okay, so it's like divergence, you know, and this is a very, very, very good point to have a look at this. Now, it's like, remember, and probably we'll look now at PE ratio, and it will be clear why. Look at the PE ratio. The lowest PE ratio was probably for the last 10 years. It was here in 2009, 13.4. in the crisis time it was 16.9. So very close to what we have now. We have 15 now. Okay, after that, PE ratio start growing. Look at this, it was 15, 20, 23, 25, 25, 29. So what tells us? If we look at the graph, remember I was drawing that intrinsic value, the earnings of the company was growing this way, but the price of the company was growing faster. And it took several years in order to get to the point where investors stopped feeling confident about the price. And there was some issue here on the $97 level, which triggered the drop. But the thing is, did it drop below the intrinsic value? Did it become undervalued for us? And where it's going to stop here, we don't know. At the moment, it's still on downtrend. Okay, but when it's turned around, okay, it will go back up again. So because for us, it's important, is it in this territory or not, or higher yet? Okay, and that's what we're trying to figure out. And we're going to base it on our strategic analysis. Okay, so that's how it works. If we buy it here, it still can go a bit lower because we never know how stressful people about the company specifically and what kind of news are going to be in the future. Okay, so that's the thing. But definitely we can see that PE ratio dropped quite a lot because earnings are still growing, and we can see that current price is the price which was in 2014, $55 here. Okay, and we can see, or even here in 2012, $51, the drop here. But the earnings were here $1.90, and now it's 3.4. So earnings grew nearly 2 times, but the price now is like in 2012, which is illogical from like profitability point of view. Okay, if we look at sales, we can see in general for the company, we can see it's growing, and so also we can see that the profit also growing. But when we look at the amount of shares outstanding, we can see that they start buying shares. So it was 139, then 136 million, 134 million, 130 million, and they're planning to bring it down to 116 million of shares outstanding. So our profit will be growing not only as a whole company growing, but a bit faster because they are buying shares, and amount of shareholders becomes smaller, and of course the profitability per share becomes bigger. Okay, also we can see that number of stores, which is pretty good. We can see they're constantly growing. 760 stores, 800, 900, 1000, 1080, 100, etc., etc. Now it's 1738. This year they're planning to open nearly 130 stores new. Next year 100 stores, and then to have in 3 to 5 years 2,300 stores. So we definitely, when we see this projection of value line of the price growth, and now we're going to look at the projection of the company growth, so we can see where it's coming from. So it's not just based on whatever imagination of directors. We definitely can see that they have a history of opening new stores, and they're trying to open and move geographically into this area. So it's good. Also, if they start picking up online sales, it will help it as well. Okay, at the moment this area is undeveloped in this company. At least I'm not sure because I cannot open their website right now. So I don't know, guys. You can analyze it if they have online presence and you can order products online or not. But if they have it, it's kind of good. Okay. Now then we can see that their gross margin is all right, 35%. But when you look at their profit margin, net profit margin, it's under 10, so it's not that great. Okay, when you look at some companies in biotech industry, you will see it's huge net profit margin there. But the good thing, what I've noticed, it's growing. You see, it was like in a bad time, it was 2.7%, and now it's 6.4, and they're planning to go to 6.8. And I presume this growth happens because they increase sales, but expenses are not growing as fast as sales. And you probably understand that salary of CEO, accountants and etc. etc. They're not growing proportionally. Okay, and maybe in the most stores they have, there are less distribution centers they have to have for the certain amount of stores. Okay, it helps out. So, and that's why their profitability was growing faster than their sales level. Okay, but we're going to look at this now in a second as well. Okay, then another thing is return on total capital is 22%, and on shareholders' equity it's 30%, which is fantastic. Warren Buffett is trying to find something above 10, right? Here it's 21 and 30, so which is pretty fantastic for us. Okay, so as investors. Okay, now this part, guys. Do you have any questions on this part? Okay, great, fantastic. Okay, let's have a maybe before we go, let's have a look at debt structure. At the moment, they have 638 million of debt, and the company currently at 7.3 billion capitalization. So it's less than 10%. So it's not that bad. And if we look, did they always have this debt or not? If we look at long-term debt, we can see that they had really low debt, like 1.2 million for quite a while, and only in 2015 they start accumulating debt, 167 million, then 289 million, right, and now 625. Why do you think they've got this debt? Yeah, that was one reason. It's completely right. In reality, what happened that here they had an acquisition. They bought another company. Correct, Ilya? Yeah, they were buying. Also, they are buying shares. Before you see they were buying still shares, but now they're buying even more shares. So they use that money in order to do that. Okay, so and if we look at net profit is, for example, last year it was 437 million, and they have debt which is 638 million. So how long does it take for them if they decide to use this profit in order to pay their debt? How long does it take to pay it off? 1.5 years. But if we look at cash flow, you can see that cash flow is always higher than their net profit. So they actually have cash coming into the company always much higher. So some of them expenses which they use, they're not like real expenses. It's just paper, like they don't have real expenses. So, and we can see it's 1.5 times higher. So in reality, if they want a cash to pay that debt, probably they will be able to do it within 1 year because it's 1.5 times higher. So it happens 1.5 times faster. But looking at the projection, right? Where is it? Long-term debt. They're not planning to reduce it, or maybe value line doesn't tell anything about it. Okay, maybe they're going to use this cash in order to buy back shares and stuff like that. Okay, so that's what happened about the debt level. So it's not bad. Right? Now, current assets and current liabilities, we can see that they have quite low level of cash. Okay, practically no, 72 million cash only, and they have quite high level of inventory. And for me, which is not that very good, I can see that it was 1.28 billion of inventory, then 1.36 billion, and now 1.65 billion of inventory. And to have so much inventories, it's not always good. Okay, it's growing. But if you look at the ratio here and current liabilities, it's 800 million, and their current assets 1.8 billion. So they have 1 billion in excess here. So it's not, they like current account situation is pretty good one as well. Okay, the only thing for us, how quickly they can move those inventories and generate cash. That would be crucial. Okay, another part which is important for us, growth trend. If we look last 10 years, so what we can see, sales growth 13%, earnings 20%. So they're growing in earnings much faster than sales level, which is we already noticed when we were looking at and calculating, right? And if you look at the last 5 years, so the sales growth slowed down a bit. So from 13.5 it becomes 12.5, but the earnings, they actually went even higher. So they sell less, but they make even more money. So 21% growth, which is fantastic. And they also start paying dividends. And we can see that dividend growth was 45%. And that's why I read quite few forums about this company, and people love it from dividend perspective. Now Dory is writing sale is nearly 2B a quarter. Inventory would be used in 1 quarter in theory. 2 billion. Okay. Now inventory, it's what you have. That's a balance sheet. Okay. They might use the same inventory, or they might have to buy new inventory. It depends on the product, because you might buy a product A, and then next quarter you are selling only product B. You never know. That's the thing. And because they have quite range variety of products, we don't show. Yeah, more stores, more inventory. And of course, we have to compare. The best way is probably will be is just to see the growth rate of sales and growth of inventory. So we can calculate it here. So it was 1.3 billion and now 1.6 billion. So it's the growth of inventory is about 300 million. 300 million, it's around what, 25% here. Now we look, okay, did their sales level increase 25% last year? And probably if you look, it wasn't. Okay, so let's have a look. Sales 6.7 to 7.2, so it's about 600 million increase. So it's 10% increase in sales and 30%, 25% increase in the inventory. So that's probably the area where we have to watch it out. Okay, so what's happening? Why they get all these products? Because we don't know what kind of products. Maybe some products will be moved in any way, but some products maybe not. Okay. So that's kind of important thing, especially if some products they have expiration date. For example, food for stock and pets. Okay, what is going to happen with it? But 1.6 billion, if their sales level, as Dorian mentioned, nearly 2 billion, so they might move completely whole stock and nothing is going to be left. So they will renew. It's dangerous when we can see that, for example, once we analyze New Skin, like about 2 years ago, and they had inventory, which based on their sales, quarterly sales level, they would have to sell nearly 2 years in order to completely sell the inventory. In this particular case, it can be sold within what, 3.5 weeks, so which is not bad, right? So this situation is pretty good as well for us. Now, if we look at our future estimates of value line estimates, we can see that they're thinking of growing 10% in earnings and 10% in sales, like in both. It's equal, like just a little bit. Maybe that's what scared investors, because they always expected that earnings are going to be growing faster, and now they're going to be in the same level, and that's why the price started collapsing like hell, right? So and dropped down so much in this particular case. So that could be the trigger, their projection on the future sales level. Okay, but looking at the future, it's still pretty bright, right? We analyzed so many companies already, and you know that to find a big company with such growth rate, it's quite difficult in many ways. Also, the interesting question: do you think this trustable? These numbers, can we trust those numbers? If previously we can see, yeah, definitely, because here they had much bigger growth. Maybe they even have a conservative growth. I don't know. I didn't reach where 2 years ago. Okay, we might see that they had similar projections. I'm not sure. I have to have a look at value line report, but that's what was happening, right? So it's interesting. Same as we look at Indian companies. Remember, they always have a low projection, and then in reality, they always overbeat them. Okay. Now, another thing which is interesting is here. Look at this corner. Look at the earnings predictability, 95%. Price growth persistent, 95%. And only stock price stability, 60. I presume that was affected by this huge drop, okay, in this particular case. Now, we're going to look at technical analysis, but you will see that the quite big drop happened when they missed their earnings, but they missed their earnings on a very small fraction what they promised. And when I look at this, I thought it was overreaction on that particular report. But when I kind of look at this earnings predictability, who remembers the company which has very high level of earnings predictability? We analyzed it not that far away and mentioned quite a lot. Yeah, Nike, definitely. Imagine that. What kind of investors are attracted to specific this type of companies who don't like any surprises, right? And they pay a bit more for the companies like that. And that's why we look at Nike. We can see that Nike is trading now at PE ratio of 24, roughly like that, 23 to 25, right? PE ratio in this case. So that's where was this company too. As soon as they start missing their earnings, all these pensions, they start, oh my goodness, panicking and selling it off, right? So that's why the situation may be happening. Maybe I'm not sure completely, but based on psychology, right? So we can assume that because for stable people who want the security when they missing something earnings, right? So they're trying maybe to get rid of or move to another company which is more stable, especially if there are bad news surrounding this company. Now, if we look at sales level quarterly, I've noticed that the second quarter and the fourth quarter they're always better than the first quarter and the second quarter and the third quarter. And specifically, the best one is probably the second quarter, which is going to be now next week. They're going to have a report on that quarter in June. So we can see that 11, like 1.1 billion here, 1.5 billion, and then 1.3, 1.5 again. Okay, yeah. So, but remember that some investors, the way they look the growth on a quarter base, they can see last quarter was so much, now that's so much, and they start buying after this quarter. Okay, and the price rises up. So, and probably sometimes it's the best time to sell it at this moment, right? And to buy it after the worst quarter, like that's what happened last quarters when they had worse results. Like from 9.9 billion, it dropped to 1.5 billion. And some people see this drop and say, oh my goodness, look, 2 quarters was growing and then this huge drop, and they start selling it off. But if you look at the annual, we can still see the growth. 11, 1.1 billion, 1.3 billion, 1.4 billion, and now 1.5 billion. Still 100 million growth here on a quarterly basis, like if you compare it, same quarters. And that's what we see they expect to show us next quarter. We don't know if they show that. Who knows, maybe the price will jump like Nike last earnings report. Okay, but if they miss it again, maybe the rest of those scary investors will start selling this company, and maybe this price will drop even more higher. Okay, and then we can see dividends steadily increasing. They already had this increase on probably announced it that it's going to be 27 cents. So we can expect 4 quarters of that, and probably will increase after that as well. So that's the range of products. I already mentioned that. So that's what I'm doing. Officers and directors, they own 1.2% of the company. It's not that big, but it's about $70 million only based on their capitalization, but maybe 80 millions of dollars. But what I noticed that 3 funds, they own 25% of the company. So, and who knows, maybe the price was affected by one of the fund leaving the position, okay, from that particular company. So that's the company description. So do you have, guys, any question on fundamentals? And basically, what do you like this company based from, let's say, what do you think? Is it a good quality company or is it bad company? Yeah, definitely. It's really good company, strong company. The only missing part here, I would say, that they don't have that much online presence. But again, I couldn't analyze it properly because the website is not accessible for me. You might do it and then comment on our Facebook. So see what is happening in this area. And then inventory, like the draw. But again, even the growth rate in inventory quite high. Maybe it's just temporarily, or maybe because it was offsetting the low inventory before that. Yeah, okay. So let's have a look quality analysis based on TSCO. What we can have at 45, so it's quite high, close to 52. We always look where they're losing, and they're losing points on industry ranking. So industry not perfect, it's 31, but still quite good. So it's 1 point missing here. Timeliness, it's 3, as I said. So it's again, it's losing 3 points here, and then safety. Okay, it's not the kind of the base safe company because the price volatility. Okay, and again, it's losing 3 points here. But the rest, the most debt, one of the important factors, the perfect situation, less than 10%, beta close to the market, also good, and growth trend is the best in this particular case. So that's why we get 45 points. So it's a quality company. We can put it in our like watch list of quality companies, and then when we feel that it's time to invest, we can buy it. Okay. Now, when we analyze the price for entering the position, so again, just repeating, we're taking the highest points, highest prices within the last 5 years. We take the lowest prices within the last 5 years, and then earnings within the last 5 years. So what we can see when we add them together and then divide by 5, we can tell that the in average, right? So average number was $80. That's the highest point which people were happy to pay for the company in average for within the last 5 years. And the lowest point was $54. And we probably can tell straight away that it's now below that number, $54. And the earnings were $2.6. So for us now, okay, in average, company was making $2.6, and people were paying $80 for a share. So what's the difference? So we divide 80 by 2.6, and we get 30 times. So when everything was rosy and people were happy about the company, news were fantastic, people were happy to pay 30 times of their earnings. Okay, and based on value line projection, that if the company keep growing in the same range, we can see that value line project is going to have $5.4, $5.45 earnings in the future. Okay, if it happens, assumption, and if sometimes in the future investors will be paying 30 times again of their earnings, we can expect that the company price will jump to $167. And now the price is $52. So it means that more than 3 times of the growth, okay, more than 300%. Now, but we need to look at consideration of lower price. Okay, if the company was making $2 and at the worst time, investors like were buying at $54, so we divided 54 by 2, we get 20 times. So we can tame that when the time wasn't rosy, when the time was bad, investors were paying 20 times of their earnings, right? And now, okay, in order to see this, the worst case scenario for us, even though we know that the company is growing, we take the last year earnings, which is actual, okay, and multiply it by this lower multiple, like 20. So we get $67. So we can assume that sometimes in the future the share price has to be based on those valuation at $67. But what's the current price now? It's $52. So it's already way below that price. It's nearly 30% below that level. So we don't have historical for the last 5 years the price as low as it is now. Okay, if we look at based on that analysis, so we'll see that the share price fluctuates between 67 and 167, so which is 100 difference. So and then we split it's if it's below 100, we consider it like 30% of time is going to be here, 30% in the middle, and 30% of the time is on the above, like 1/3, 1/3, 1/3. Okay, so we can assume that between 67 and 100, it's buy territory, then hold territory, and then sell territory. So we actually now is below buy territory, so definitely in buy territory. So when we assess our risk-reward ratio, we can see that from 55 it could go to 167, and if it's on a fall, actually we fall already below the fundamental price, low price. Okay, based on fundamentals, because investors, they are scared right now and they're selling off this particular company. Okay, now, so if you put all these numbers, it's actually becomes the best on the score, 55 points out of 55, or 52 points out of 52. So it's very difficult to find sometimes companies like that. And so it took me quite a while to find this company and analyze it for you guys. But still, we can see that it's a pretty good price right now. Book value is $11. It's actually tangible book value. So it's 5 times of the current price below. So it's not that high. And earnings 26th of July. So, and remember, you have to be always careful before you purchase anything before earnings. You have to think twice. And we already looked at several companies that on earnings they can drop. They have huge drop. And actually, we're going to look now at technical analysis of this company, and you will see that they had a huge drop on a small miss. Even the sales and earnings were growing from year to year, right? But because they missed their earnings from their promises, the share price collapsed. And we saw opposite situations like Nike last quarter, like last month, when they had not otherwise after earnings they jumped up 10%. But it's always better not to make money and miss the opportunity rather than lose money. So that's why I think twice before you, or 3 times before you purchasing anything before earnings. Of course, if you already have a company in your portfolio, it doesn't make sense just because earnings are coming up. Okay? Something like that. All right, guys, is all clear on that evaluation? If you have any say, just let me know. Okay, perfect. Okay.